So welcome everyone. This is the weekly SEMLA's research webinar where we have been studying topics related to monetary policy and financial stability. This week we have the pleasure of receiving Enrique Mendoza. Enrique is the Presidential Professor of Economics and Director of the Penn Institute for Economic Research at the University of Pennsylvania, where he joined in 2013. Before that, he was a Neil Moskowitz Professor of Economics at the University of Maryland and held positions at the IMF, the Board of Governors, and Duke University. He got his PhD from the University of Western Ontario in 1989, and he's a research associate of the MBR. He also participated as a former panel member of the NSF Economic Program, and he has served in the editorial boards of several academic journals, including the American Economic Review. Enrique's research focuses on international capital flows, financial crisis, sovereign debt, and international business cycles. And his main publications include a general equilibrium model of sovereign debt, of sovereign defaults and business cycles with Vivian Jue, was published in the Quarterly Journal of Economics in 2012. Southern Stocks, Financial Crisis and Leverage, published in the American Economic Review in 2010. Financial Integration, Financial Development and Global Imbalances with Vincenzo Condrini and Jose Victor Rios Rule in the Journal of Political Economy in 2009. And perhaps his most cited work is a model on real business cycles in the small open economy from 1991 in the American Economic Review. So I'm sure most of you know his work. So we are really happy that he will be talking today about 4 different papers that he had worked on that are summarized from credit booms to credit crisis. And given that Enrique is going to be talking about different papers, he asked us if we can just stop him by asking clarification questions during the presentation and to leave the content questions to the end so that he can make progress with the presentation. So without further ado, welcome Enrique.
Thank you very much, Alberto, and thank you, SEMLA, too, for inviting me to give this workshop today. I really appreciate it. So we have 90 minutes, right, to do the presentation. I will try to speak for about an hour and 10 or so, and then we can have the more substantial questions that you have for that time. And then if you do have questions about clarification as I talk, please feel free to ask them. So as Alberto was explaining, this is a presentation that involves a combination of a line of research, various papers that I've been working on the past few years. And it's sort of combining various ideas that have to do with the connection between the phenomenon of fast credit expansions or credit booms, the collapse of these credit booms into financial crisis, some empirical work that's looking at how to characterize this from data, some modeling work that tries to look at a particular class of models that I will refer to as Fisherian models of financial crisis, and then the lessons that follow for policy. And here I will focus very much in particular on the case of the macroprudential financial regulation. This is the first time I use this way to present, so you bear with me if I get stuck. So this is what I planned for today. I will talk first about empirical work, which is essentially work that looks at cross-country stylized facts of credit booms, takes a stance on how to characterize empirically this phenomenon, and then goes to examine comparison across countries, both industry and developing, in terms of the size of credit booms, the frequency at which they occur, the duration that they have, how they're associated with crises, what kind of macro dynamics they are associated with as well, and frequency analysis of the factors that precede them. Then I'll talk a little bit about these Fisherian models and their quantitative implications. So the focus is going to be both in looking at models that theoretically may be capable of explaining the characteristics of financial crisis, but are also quantitatively seem capable of generating financial crisis that match the observed features of financial crisis in several dimensions. And here I'll try to cover what I think of as the two pillars of the Fisherian framework. One, which is the more widely known mechanism of debt deflation, which is the mechanism that gets triggered when debtors face collateral constraints that force them to fire sale assets or goods, therefore creating a spiral in which the prices of these collateral goods or assets start to fall, making collateral constraints more binding, forcing them into further fire sales. So that classic mechanism. The second feature of this Fisherian framework, if you actually go back to Fisher's work of 1933, has to do with the interaction between that mechanism, the debt deflation, and the process of financial innovation that occurs in financial markets secularly, and the beliefs or the ideas, the thinking that market participants have about the future prospects of financial markets and the overall macroeconomy. So Fisher's paper is not a well-developed model. It's more a collection of thoughts of all these different things. But you certainly see there an interaction between both of them, this process of dynamics of innovation and belief and the debt deflation mechanism. And finally, and then we'll see, depending how we do on time, how much I can cover actually of the two, but I will try to say at least a few words about both. And then intertwine during my discussion of these topics in the second bullet, I will bring in the discussion about macroprudential financial policy. Particular 3 points. It's very important to base discussions of macroprudential policy on pinpointing exactly the form of market failure that one is going to argue to motivate or to justify the use of macroprudential tools. I will focus in particular in this class of models, the Fisherian models. There is a pecuniary externality that is a form of market failure that relates to the fact that collateral prices are market prices, and therefore their dynamics are not internalized by individual market participants when they make borrowing decisions. And I will be clearer about what exactly does that mean and how does the pecuniary externality take life in these Fisherian models. Then I will highlight how macroprudential policy comes into play, and I will distinguish macroprudential policy from what we normally consider ex post policy. So in the discussion of policies to deal with crisis, one can talk about ex ante policies. That's where the macroprudential family of policies will be, and ex post policies, which is intervention that you do when a financial crisis has already begun. So macroprudential is pretty much about what you do in good times in order to reduce the frequency and the magnitude of crises when crises do occur. And then I'll speak in a more positive tone about it, about what this class of Fisherian models tell you, how far you can push them into the design quantitatively and the quantitative evaluation of macroprudential policy tools. And then about problems that we also have in pushing further the design of these instruments and in using models for evaluating these instruments. Problems that have to do with timing consistency and the credibility of these policies. Problems that have to do with informational frictions in the design of these policies, the heterogeneity of market participants, the coordination, and particularly here the discussion with monetary policy is an issue as well in terms of the classic sort of targets versus instruments, Tinbergen rule, and other features. So that's broadly speaking what I'll try to talk about. There's a very large literature, obviously, when you're writing about these things, looking at them from empirical perspective, quantitative perspective, modeling perspective, theory-wise. So I don't really have time to go in detail through the large body of literature that really serves as background for this kind of work. Certainly empirical work, there's a large collection of those, and these are just a few sites in them. From the theoretical literature on financial amplification and macroprudential policy, then it's also very large and growing literature. And also from the literature that takes these models into quantitative applications, and in particular from that literature that is a quantitative literature that takes it into examining macroprudential policy. It's also a young but growing body of literature, and there's all kinds of further derivations people are looking at. So you can think of this slide as just an initial kind of condition if you are interested in any of these topics and want to pursue them further. So let me move to the first topic. So here I'm going to talk about this empirical work, and it's based on work I did with Marco Terrones, the IMF. It's a work that we sort of did in two stages. When we started, actually, we had a data set that ended just in 2006. And that was a first paper Marco and I wrote that kind of highlighted or tried to highlight that, in fact, credit booms were very different phenomenon when you compare industrial countries and emerging economies. Now, of course, if you stop the data in 2006, you were missing all the recent financial crises, the bulk of which had an industrial country crisis and which occurred in the aftermath of credit booms in industrial economies. So when we look back at this exercise with the data ending in 2010, 2011, depending on the country, what we found is that, in fact, there's a lot of regularity in what occurs during credit booms across countries and in the aftermath of credit booms across all countries. So I will try to make these points clearer as well. So what we do here is use what is known as a thresholds methodology, and is widely used in macro and international macro and empirical studies to characterize dynamics around a well-defined event. And our event is in particular what we define as a credit boom. And depending on which side of the empirical literature that this you take, you're going to find different definitions of what a credit boom should be. Here, definition is based on looking at the cyclical component of the logarithm of real credit to the private sector from the broadest definition of the financial system for which we could find data. In the majority of countries, given the limitations of the cross-country databases, this turned out to be commercial bank credit. But for some of the countries, it goes beyond the commercial banking. Expressed in per capita terms, logged, detrended with the HP filter in the standard way, so it's very, very standard the treatment that we do. We create the standard cyclical component for credit, which is L for each country I at day T, what you see in the slide. And then we're going to define a country to be in a credit boom when it has crossed to be greater or equal in the cyclical position of credit than a fraction or a factor of the typical business cycle in credit. What is the typical business cycle in credit for us? It's just going to be a standard deviation of the cyclical component of credit. And in the paper, we examine different ways to define phi, which is a threshold factor for defining a boom. But the most agnostic way is to say we want to look in the 5 percentile of the distribution of the cyclical components of credit per capita. And that would put phi to something close to 2 standard deviations. So effectively, if you want to think about phi as being the number 2, that's pretty close. The methods, the difference with other methods, I'm not going to spend time on that right now. So what we find when we look at the data is the following. We have data for 61 industrial countries and emerging economies. The data spans from 1960 to 2010. And using, again, as I mentioned, the 5 percentile threshold, what we find are 70 credit boom events across the sample of industrial and developed economies. We find about 35 in each group, so half and half. And overall, if you combine the entire data set, this will result in a 2.8% frequency of credit booms. So credit booms are relatively rare events. If you take the generous assumption that the data generating process is common to all of these countries, the implication here is to say that the probability that a country enters in a credit boom is 2.8%. Now, they tend to be clustered around big events. So again, I'm not going to give you all the detailed charts and analysis that we do in the paper. But when you do look at the paper, you'll find that if you look at events around, say, the Nordic crisis or the ERM crisis of '92, you'll find a bunching of credit boom events from industrial countries around that time. If you look in the year or years just before the debt crisis of the developing countries in the 80s, you also find a clustering of credit booms around for developing economies. Similarly, in 90s, before the financial crisis of the 90s, the sudden stops, you also find a clustering of these credit boom events. You look at the macroeconomics and you say, let's take the dating of credit booms to center event windows of what's going on with cyclical components of various macro variables. You find a very strong association. That is to say, when a country is in the upswing of a credit boom, its business cycle is going through an upswing. When a country is entering into the downswing of a credit boom, similar things happen on the macro side and the asset prices. And for this, I'm going to show you some charts in a minute. We also did some micro or disaggregated level data analysis using data from bank scope and world scope with the limitations that that has. And we find again using event windows centered on the date of the macro dated credit boom events, we found that very clearly defined financial dynamics at the level of firms, non-financial firms, as well as the level of at the level of commercial banks. We found that they're similar in duration, so regardless of whether you look at emerging or developed or industrial countries, they tend to last from 5 to 6 years, and also in size. If you look in absolute levels, they're different in size because emerging markets are significantly more volatile, so their cyclical component of credit is larger. But if you normalize by the fact that indeed the standard deviations of credit are larger in emerging markets than in industrial countries, what you tend to find is they're fairly common in size. If you look at frequency analysis of what happens in the aftermath of credit booms, what we find is 1/3 of credit booms tend to end in a banking crisis or in a currency crisis. So yes, credit boom events are rare events, 2.8%. But once you are in a credit boom, the chances are 1 out of 3 that the credit boom will end bad for the banking system or for the currency. In terms of factors that precede them, again, just doing frequency analysis, what we tend to find is that roughly between 1/4 to 1/3 of credit booms are preceded by financial innovation, thinking about this as literally financial reforms, or more indirectly if you try to measure them through surges in capital inflows. You could also think about the second measure, surges in capital inflows, as a measure for global liquidity. So if you want, it also tells you that roughly 1/4 to 1/3 of credit booms are preceded by these episodes of growth in global liquidity. And also it comes out very clearly from the data that 2/3 of these credit booms occur under managed exchange rates. So there's a very strong association between exchange rate management and the occurrence of these credit boom events. This is the first picture. It shows you just the event window for credit per capita, the cyclical component, for the mean and the median across the industrial country sample, the mean and the median across the emerging economies. We show both just for questions that may relate to the dispersion that the data could have. And date 0 here is the date of the peak of the credit booms, and we're looking at 3 years after and 3 years before the peak of the credit boom. So these are 7-year event windows. So as I was saying earlier, in absolute terms, credit booms in emerging economies tend to peak somewhere around 30% in terms of the deviation from trend. So it says at the peak of a credit boom, credit is measured per capita is about 30% above trend in emerging economies. Roughly half of that when you look at industrial economies. As I said, in this group of countries, credit is less volatile than in this group of countries. So if you were to do the exact same plot in terms of the size of the cyclical fluctuations of credit, the plots will be similar in terms of their peaks. Now we're going to look at the association with the macro events. So here we're looking first at the cyclical component of credit. So again, in these other event windows, date 0 means the peak of a credit boom. And then we're showing 3 years after and 3 years before the peak of a credit boom. So you can see very clearly that in both groups of countries, you have a very clear upswing in the business cycle when the upswing of the credit boom is taking place. So output is moving significantly above trend in both groups of countries, and more so in emerging economies than in industrial countries, but very clear pattern in both. And in the downswing of credit boom, output ends below trend, about 2.5% in industrial countries, about 3.5% in emerging economies. And similarly, if you keep going through the charts, the ones I have in the presentation or the ones we have in the paper, similar things you find for out consumption and investment. This is again industrial countries and emerging economies. They both clearly display a cyclical pattern in these macro aggregates, in these event windows centered at the peak of credit booms. So there is a lot of regularity again in what happens during these credit boom events. One aspect in which there is not such regularity is we were motivated by the stories, many of which we have in the models that were written after the sudden stop crisis, looking at balance sheet effects and the intermediation of dollar borrowing into domestic currency, through domestic financial systems in emerging economies. So we were interested to see if the data could tell us something about that. So here we did a decomposition of non-tradables components of output and a real exchange rate as a proxy for the relative price on non-tradables. And here you can see very clearly that for industrial countries, there is not much of a story in this picture, not much is happening. But when you look at emerging economies, again, you can see a very clear upswing in non-tradables output and a very clear moving to below trend in the aftermath of a credit boom. Very clear real appreciation. This is using the IMF measure of the real effective exchange rate, and a very clear pattern towards a sharp depreciation shortly after the peak of a credit boom. So in this context, industrial countries and emerging economies do seem to show some interesting heterogeneity. Current account is very typical. So the current account goes into a sharp deficit. The timing is not exactly perfect, so you can see for industrial countries, the trough when the current account is reached a year after the peak of a credit boom. But you can see significant current account deficits in both groups of countries and sharp corrections, particularly in emerging economies. So you could think about doing, and this is empirical literature has done it, about doing these kinds of exercises in different ways. So you could think about defining the event as a sudden stop, and there is significant work on this, a lot of it done by Calvo, Izquierdo, and Talvi, for example, or Calvo, Izquierdo, and Mejia. And in that literature, you could ask the question, are all credit booms sudden stops, or are all sudden stops credit booms? So what we found in our analysis is that all the classic, well-known sudden stop events were credit booms. Not all credit booms are sudden stops, but all sudden stops that we know of the family of the classic epic examples, they were all credit booms. Here is looking at asset prices, and this is going to be important as we look towards the theoretical models, that there is a very clear pattern of upswing in asset prices in the upswing of the credit boom, and a very sharp correction in the aftermath. And this is true across emerging and developing countries, and it's also true across housing prices, which are the bottom charts, and stock prices in real terms in the top charts. So there is a sharp correction in the prices of all types of assets that occurs in the aftermath of credit boom. This is the one chart that we want to show you from the disaggregated data. This is from bank level indicators, non-performing loans, the loan-to-asset ratio, the return on assets as a measure of profitability, the capital adequacy ratio. And you can see a very clear pattern in these plots, again, event plots based on bank scope data centered on the peak of a credit boom. Keep in mind, the bank scope data tends to be fiscal year data. The data that we use for the macro part and the banking data are from IFS, so that's calendar year basis. So they don't quite center, but generally what you see in these plots is roughly a picture of expanding banking systems in the upswing of a credit boom and corrections in these banking systems in the aftermath. So non-performing loans rise, loan-to-asset ratios decline, profitability decline, capital adequacy ratios first falls and then rises. Here are some pictures about the frequency analysis. So first is about potential triggers, if you want to think about them in this way. So the blue bar is for the countries, the red is the industrial economies, the green one is the emerging countries. And you can see three ways to order the data. One is to think about measures of increases in capital inflows, measures of large increases in total factor productivity, with the limitations that we know that those measures have at the aggregate level, or measures of large changes in financial sectors using various indices also created at the IMF. So this is what I was saying at the beginning, that if you look at the level of all the countries, roughly 35% of credit booms were preceded by surges in capital inflows. And the pattern is even stronger for emerging countries. So whether you want to interpret this as a feature of financial innovation or as a feature of these waves of global liquidity, that's pretty clear coming out from the data. TFP not so much for emerging economies, for the sample as a whole, but it comes out clearly on industrial countries. And financial innovation comes roughly about the same, a little more significant for developing countries or for emerging economies than for industrial countries. This is with association with exchange rate regimes. As I was saying before, very strong association that managed exchange rate regimes tend to be the ones that you observe most frequently in the years that lead up to the peak of a credit boom, and much less so in alternative regimes, either floating, mixed, or dirty floats. This is the frequency with which crises occur in the aftermath of the peak of a credit boom. This is again what I was saying earlier. If you have 38% probability, 3.8% probability of, 2.8% probability of having a financial crisis, of having a credit boom. Once you are in a credit boom, the probability that you will have a banking crisis is about a third, and it is only slightly different across the groups of countries. Similarly for currency crisis, and for sudden stop, the probability is less frequent, and it's higher for emerging countries than it is for industrial economies. So again, the bottom line from this combination of pictures is to convey the impression that credit boom events defined as events in which you have unusually large credit expansions such that they put the cyclical component of credit at the 5th percentile are infrequent, and when they do occur, probability that you will end up with some kind of crisis is roughly 1 out of 3. So that is why this phenomenon should be, and is rightly so, a focus of the attention of policymakers. Now, of course, as you know from all the debates that came out the financial crisis in the US in academia, it is not clear exactly where macroeconomics can take us to derive the clearest pictures as to how can we rationalize the occurrence of this phenomenon, and then to have sound quantitative models for characterizing the dynamics of financial crisis on which to justify and base and later quantify policy interventions to address them. So here, as you know, this is for the emerging market literature. For us that were working on the sudden stops crisis, it wasn't really something all that new because we had been worried about this financial amplification phenomenon since then. But for the larger chunk of at least American academia, it was a bit of a shocker, and it came in the aftermath of the financial crisis in 2008. That's not to say that there wasn't also a literature on financial amplification before 2008. As you go back to my literature slide, you'll see the classic works of Kiyotaki and Moore, for example, which are from 97, or the work from Minsky in the 60s, or even go back to Fisher's work on the 30s. But here I'm going to focus on this particular class of models. So again, in the current literature, there is a wide coverage of different hypotheses that can drive financial amplification and financial crisis. In this presentation, I'm going to focus on the so-called Fisherian models. So the key feature of a Fisherian model, or what I'm referring to as a Fisherian model, is that they introduce these credit constraints in which debt cannot exceed a fraction of the market value, and I emphasize this, you'll see why, market value of the assets or the incomes that serve as collateral. So the key feature of a Fisherian model is that there is a market price that determines borrowing capacity by borrowers. So here is an example that I will use because it's based on some of the work I've been doing, in which with Javier Bianchi, in which agents may borrow up to a fraction of the value of assets they can offer as collateral. So here in particular, think about borrowing as being done in one period real bonds. This bond says a small open economy, so their price is 1 over the world interest rate. And these are all one period bonds. So what this constraint will say, this Fisherian constraint, is you cannot borrow more than a fraction kappa of the value of the asset holdings that you have. These are the asset holdings of the individual, and this is the market determined price. Or if you want to think about a richer model, which is also the kind of model I'm going to use later on for my examples of macroprudential policy, you can add this feature that firms also need working capital financing. You look at this literature on financial amplification, particularly the more recent quantitative one, it is an issue too, how to connect financial amplification not just with collapses in aggregate demand, because that's relatively easy to do, but also to have strong supply side channels. So one vehicle to do this at least is to consider working capital financing. So here is a rewrite of this collateral constraint in which we assume that yes, you can engage in one period borrowing in these international bonds. You may also need to borrow for a fraction theta of the wages bill. So let's think about this as working capital that says that you need to obtain credit from abroad for a fraction theta of the amount of wages that you need to pay. So in this simple characterization, the total indebtedness of the economy is what cannot exceed a fraction kappa of the asset holders. With more time, or if I were giving just a seminar on this paper, there are interesting issues about the micro foundations, or where collateral constraints of this kind can come from, the timing that they could have depending on the timing with which transactions are taking place. There's also discussions about decentralization of whether firms should be the ones that face this side of the constraint, individuals borrowing, say, for mortgages, should face this type of the constraint. There are heterogeneous borrowers, so should we carry different values of kappas and so on and so forth. But for today, I'm going to focus on this sort of representative agent representation. So what are the two key features that I want to emphasize of this? Okay, so Alberto asked this question. So in general, no. Here we're following the tradition from the working capital models that we had in the neo-Keynesian DSG literature or the RBC literature, or the Fewers class of models, where we think about this working capital as financing variable inputs. So typically people would use it for labor, for intermediate goods, but not so much for capital goods, because we think of those as goods that for which you don't need to be paying in advance. So remember, from the first approach, we think about working capital as kind of a cash in advance constraint. So that's why it's normally used for thinking about wages or other variable inputs. Okay, so two key features that I want to highlight about this constraint. First one is, as I mentioned at the beginning, financial amplification. That's the debt-deflation spiral, and I already talked about it at the beginning. One thing I want to add here is that this credit crunch, this spiraling deflation of asset prices and borrowing capacity that we call the debt-deflation spiral, should be able to trigger both collapse in aggregate demand and also in supply. So I want you to think, when I use insufficient aggregate demand terminology, for example, here, don't think on it from the Keynesian perspective. In fact, it's very different from the Keynesian disequilibrium, because at the core of what happens in the Fisherian framework is price flexibility. It is the fact that the prices of collateral fall that is the main problem. If the prices of collateral were rigid, substantial issue with the Fisherian deflation would go away. But there is insufficient aggregate demand and supply. It's just that the source is not coordination failure in the Keynesian sense. It's this debt deflation spiral. To bring it into the supply side, you need to have that this financial deflation spiral can affect factor demands. That's almost from a growth accounting perspective. So you can have it, as I wrote it down, through working capital. You could also have it, as I'm going to suggest, for example, when we think about emerging markets, firms that produces in the non-tradable sector, they use their goods as collateral. So when the real exchange rate correction that I showed you in the data happens, relative price on non-tradables fall sharply. That's going to reduce the value of the marginal product of demanding factors of productions for that sector. And that's another way in which factor demands may contract, even if you don't have a working capital channel explicitly in the model. So financial amplification, that's the first feature. The literature was out there on whether, despite the fact that theory tells us a lot about financial amplification, whether quantitatively this was a relevant mechanism. There is a well-known paper by Narayana Kocher-Lakota in the Minneapolis Quarterly Review that showed a very pessimistic view, in which he said theoretically this goes in the right direction, quantitatively it's likely not to do much, and I'll come back to that in the context of particular models here. So it's important, if we want to push this line of models as models on which to build macroprudential regulation, we can start by making the point that these are reasonable models to think about the dynamics of financial crisis. Financial amplification is important. Secondly, for the normative analysis, going back again to the macroprudential policy, it's important that we can pinpoint the finger, where is the market failure? If financial amplification, say, were like the typical RBC model in which business fluctuations are Pareto efficient, I could have potentially a fairly good model of financial crisis, but one that doesn't give me room to make a statement of policy, because if the financial crisis were efficient in the economic sense, then there wouldn't be a justification for market intervention. In this particular class of models, the fact that you have these collateral values determining the markets introduces this pecuniary externality. So agents do not take into account the effect of their individual borrowing on collateral market prices. So fair enough, pecuniary externality, and we know a lot about those from public finance. What's important here is that it's a dynamic externality. So the key issue is that when people are engaging in borrowing in good times, individuals and firms, they are not going to take into account how the asset prices of collateral or the goods prices of collateral will respond in the future if there is a financial crisis in the future. So that this dynamic dimension of the pecuniary externality is crucial. Financial regulator who takes that into account will tend to justify less borrowing in the good times. So that's why we also think about these models as models of over-borrowing, because we say if we do think about a financial regulator, in the good times the regulator is going to have an argument for thinking that private agents are probably borrowing more than will be socially optimal. And therefore, it's justifiable to think about policies that will contain borrowing in the upstream of the credit boom. So here is putting these elements now. I want to highlight about how far you can take these arguments in some of the more recent literature to turn them into quantitative models for the design of policy, quantitative models for analyzing how important financial amplification can actually be. So this is based on a paper that Javier Bianchi and I wrote, first in 2010, and then the revised version is from 2012. So here we're thinking, as I was saying before, what representative agent. So think about the representative agent who has preferences, this sort of Greenwood-Herkowitz-Hoffman aggregator. So it's going to eliminate the wealth effect from labor supply. You're going to have consumption and labor supply to the market by the representative agent, and this is the disutility of labor. Borrowing, this is the budget constraint. So what you have in the left-hand side are the uses of the agent's income. The individual may buy assets. These are the individual asset holdings. That's the market price. Can consume, can buy these bonds. The sources of resources for this agent are the value of its capital holdings, the payout of an existing bond position. So again, B positive here means saving. B negative here means borrowing. Wage income. And here the profits of operating this production technology. That's the value of the sales, if you want, net of the wage cost. So think about this entire term as the profits. It's a representative agent model, so all these things are going to wash out and you're just going to end up having output as usual. But I wanted to keep it here like this in order to make sense of this term here, which is the requirement of borrowing for working capital finance. But before I get there, first be clear, this is the only exogenous shock that's going to drive this model. So we're going to have what will be, in the absence of the financial constraint, a plain vanilla textbook RBC model, where the only driver of the business cycle will be standard shocks to the solar residual. And we're going to take them to be as in the data. So anything that happens here will not be because shocks are unusually large during crisis. So financial crisis, if they occur in this model, which will happen, will be the result purely of financial amplification. Put it in different words. The same realization of a solar residual that triggers a financial crisis, when it doesn't trigger a financial crisis, will produce a typical business cycle of the standard RBC like. So that's very important. It's not just a model of financial frictions, it's a model in which financial amplification can be quantified and observed. Then we have the borrowing constraint, which I already talked about. So again, without this constraint, this will be like a canonical RBC model of a small open economy with working capital. So similar to the kind of model that we think of as the canonical small open economy model these days with the working capital feature on it. So, okay, so that's what's going to drive individual behavior. So if I had more detail, more time, I will detail here optimality and equilibrium, the decentralized competitive equilibrium allocations. Think about these as the quantity and prices that come out from solving this problem here with the corresponding market clearing conditions. So now I want to think, what will a social planner want to do? So think here, for lack of a better name, Javier and I thought about calling this conditionally efficient financial regulator after suggestions from a referee. So what's the difference is that, well, the first two things look like a standard social planner. So you're going to maximize private sector payoff. So it's a standard social planner problem, subject to the resource constraint of the economy. So in a small open economy model without government and investment, this is a resource constraint. So these two things, again, fairly standard. But we're also going to assume that this social planner, think of it as the domestic social planner of a small open economy, also faces financial friction in international capital markets. So at the aggregate level, so here the capital letters denote the aggregate quantities, the aggregate level, the borrowing of the economy is subject to the collateral constraint as well. The aggregate level, we're going to consider here a model where aggregate assets are in fixed supply. Now this problem can be made more or less complex. In more recent work, we look at it also, and we go back to earlier work we had done to think about it in a more complex way. But for the presentation today, I'm going to give it a treatment that is simpler. So a simpler treatment is a treatment where we say, let's make this planner's life simpler. Let's give it whatever the pricing function that was telling us what the value of collateral would be when the economy has a certain amount of debt and the solar residual at a certain value. Whatever that pricing function was when we solve this problem, we're going to take it and stick it in here. So we're going to assume that the pricing function with which the planner evaluates collateral is the one from the decentralized equilibrium. And we're going to assume that wages are going to be valued so that we are in the supply curve of labor. Okay? So what does it mean intuitively is that when the social planner looks at the right-hand side here, point by point, it sees itself as having the same menu of possible credit positions that the private sector had. Okay, you're going to see, so that the words don't get confusing. From today, looking at V and epsilon as given, it's going to look like we have the same credit possibilities as the private sector did. Good question. So I will come back towards that question at the end. So this question has to do with whether one can think about planners that with policy could potentially remove this constraint. I will talk about what does that mean in general. I'm going to think about here about a class of problems in which that is not possible. In some of the literature, the work by Benigno, Rebucci, Otrok, Young, and I forgot one of the authors, I think, they explore that possibility. I will say in this class of models where you impose these constraints, that's a possibility that is difficult to look at because you need to look deeper into the contracting stories that are behind these models in order to be able to say, yes, indeed, it's not just an issue about the social planner thinking about policy, but unless we're talking about socialized banking systems, how a decentralized private banking industry will implement those allocations. So that's one issue. Another issue has to do with how we think that in that decentralized equilibrium, private agents are treated. Are they looked at by creditors in pre-tax form, or are they looked by creditors in post-tax form? Certainly in the United States, when you apply for a mortgage, your creditor is going to look at all your 1040 statements of the last 3 years, which means they want to look at you in after-tax terms. And that makes a lot of difference for the potential of the planner in this class of models for what they can do or cannot do. So it's not a very precise answer. I can come back to it at the end so we can talk about it. So that's not exactly a clarifying question. Okay, so that's the point. Now, so what's the big difference? Big difference is that the planner will be thinking more wisely in a dynamic sense. So what the planner is going to care is about how this price may change tomorrow with a change of B prime. Okay, so today the borrowing capacity B epsilon, value is Q, that comes from the decentralized equilibrium. When he looks at that menu of credit positions, it's the same menu that private agents face. But in choosing the debt today, the behavior will be completely different, and you'll see in a minute why. On the other hand, as I was saying, you can make these problems more or less complicated. You could say, potential is why should the planner do that? Maybe the planner would like to think about the possibility to induce private sector behavior to change. So you go back to, say, optimal policy theory about the primal approach versus the Ramsey approach. You could do this kind of thing here too, and think about policies that could also take into account how they can influence the values of collateral when the constraint is binding today or when it may or may not bind in the future. What Javier and I discovered earlier on in our research is that that results in a time inconsistency. And then we come back to that issue and formalize it in a more recent version of our paper. So then you have to either say, yes, I could design optimal policy, but it will not be credible, or you have to impose the additional condition that the optimal policy needs to be formed without commitment. But I'm going to leave those issues aside. Question again is, with the problem as defined here, where is externality? So let's look at what will be different between the private sector's optimality conditions when they're looking at borrowing choice and what the social planner will look at. So if you look at the private sector, it's the standard Euler equation. The agent will look at the right-hand side of his Euler equation, and that will be the marginal cost of the extra unit of borrowing. When the private agent does, when the social planner does that, in principle, yes, he will look at the same term. He says, that's one term that I should consider for the social marginal cost of borrowing. But then there is these other terms. So mu here is the Lagrange multiplier in the borrowing constraint. Okay, so notice, this is an expectation taken as of today of whether the constraint may or may not bind tomorrow. Okay, an expectation taken as of today of whether the constraint may or may not bind tomorrow. If from the perspective of today the constraint doesn't bind in any state tomorrow in expectations, then this whole term doesn't matter, and these two things will indeed be equal across those two contiguous dates. But if I am sitting at any date today in which the expectation tomorrow of hitting the borrowing constraint is not zero, then this term will not be zero. And when that term kicks in, the pecuniary externality becomes relevant. It means it creates a difference between private and public social costs of borrowing. Private and public costs of borrowing. What is going to be the difference is, well, of course, the shadow value of the borrowing constraint, how costly it is the fact that your borrowing is limited, but that's also proportional to how much asset price is changing. How much is your borrowing capacity shrinking because the asset price will fall when the collateral constraint binds? That's another way of stating that this derivative will be positive. That's going to be obviously proportional to how much borrowing you could take and how large the stock of assets on which the debt can take place. So this whole term here is going to be one term that we will think of it as the pecuniary externality on which the social planner will want to act to introduce macroprudential policy. Now, in this particular model, the working capital requirement also means you have this other term. The social value of how wages will change proportional to how large the borrowing constraint for the requirement for working capital is. So this whole term will also come into place. This derivative will be non-negative in general. So in general, this is ambiguously signed. What typically happens in soundly calibrated debt deflation model is this derivative is very steep in a financial crisis zone. So generally speaking, this term will be positive in quantitative applications. Now, so I was beginning to talk about this. I should not get deeper into the time inconsistency because it will eat away at my time. But here, again, just to put all the cards on the table, these kind of assumptions that we made, imposing that this pricing function is the same as the one we have from the decentralized equilibrium, also buys us time consistency, makes the problem simpler to analyze. And then again, if you want to see more reference to that, or more recent paper, which is actually 13, dwells a lot deeper into all those things. It's an important issue because it has to do, in the absence of that, we really had to think about how we establish the credibility. So the standard issues, why time inconsistency is a problem in optimal tax policy or in monetary policy, are issues that come back to bite us quite strongly in this literature as well. So I think this is something that is going to also be looked at a lot more. But in any event, in the context of this model, then what is the optimal macroprudential policy? Well, the optimal macroprudential policy should be one that forces private individuals, when they're acting unilaterally in the decentralized equilibrium, to internalize all the costs that you saw highlighted here. So we want private individuals to internalize the social cost, in a sense, to value it. So what is a practical way to do it when we have pecuniary externalities? To think about them as taxes. That's just as a starting point, again, because these are pecuniary externalities. So the goal is to use the policy to replicate the same allocations of the financial regulator as a competitive equilibrium. And you can actually solve explicitly by combining the Euler equations of the private equilibrium and the regulated equilibrium for the optimal tax. And this is what the optimal tax will look like. Again, you will see it depends, obviously, on this externality term. Now, this particular framework, since you need to make sure that the asset pricing function is the same, this is a necessary instrument. It's not sufficient. For the asset pricing function to remain the same, you also need a subsidy on dividends. And here we chose very poor notation because we call delta or subsidy on dividends. So the optimal policy that replicates the allocations of the regulator as a competitive equilibrium will be a tax on borrowing, a tax or subsidy on dividends, because actually its sign is not constrained, and everything rebated or financed with lump sum taxation. You can decentralize this in different ways. You can do it with capital requirements. You can do it with reserve requirements. And Javier's thesis dissertation talks more about this issue. It's very important here to see that this tax, again, because externality is only relevant when you expect the borrowing constraint to bind tomorrow, the tax is only positive when you expect the borrowing constraint to be binding tomorrow. So this is, again, the macroprudential issue. This is an action you will take in the good times when the constraint is not binding, depending on your expectations that it may become binding. Now, the size of the tax is going to depend on the size of all these terms. And that's why in these models it becomes fundamentally important that the nonlinearity implicit in discussing financial amplification is well captured. The global vision of what is happening in good times, how it will affect bad times, needs to be explicitly incorporated into the treatment of the quantitative analysis of this model. So let me say a couple of words more intuitively, if you want, about that. Why, when we think about implementing these models quantitatively, at least if this is the perspective is to think about macroprudential policy from the perspective where the argument is a pecuniary externality through a collateral constraint. Why in the class of models is important that we look at them from a global nonlinear methodology perspective. So think about it very intuitively. In any model, where actually for this is a general point that you can make for models of financial distress in general, whether they're Fisherian or not, the following is going to be true. Think about the liability position on a financial asset and the reciprocal of its price or the yield. Canonical examples, you could think about Bernanke-Gertler financial external premium. So this is a convex function, as we know. Think about the Eaton-Gersowitz model of sovereign default. Same thing will happen. At low levels of liabilities or financially normal times, you will be in relatively flat regions of these curves. When you enter into areas of financial distress and bankruptcy or default or fire sales become more likely, these asset prices are going to drop very steeply, which means the returns are going to increase very sharply. Canonically, in these models of default, what you have is that when you approach liabilities that are sufficiently high that default becomes almost certain event, the reciprocal, the price goes to zero and the reciprocal goes to infinity. So you can see from this end you will have a zero premium when you have no liability. From this end it has to go to infinity at some finite amount when default becomes extremely likely. So there's a whole variety of models of financial turbulence, all of which will have this feature in common. The prices of the securities will be sharply concave curves. The yields or the returns will be sharply convex curves. So I'm thinking about that for this plot, and I'm labeling the theoretical pricing function. It is certainly true in the model that I'm giving you, but what I'm trying to say now is that this applies to a wider class of models of financial distress. So here is what a local approximation method will look at. We'll say, well, okay, let's consider, say, Bernanke-Gertler-Gilchrist type model, where we have looked at this black curve as the Bernanke-Gertler financial accelerator, the external financing premium, but we have built it into a large-scale DSGE model, and we're looking at a local approximation around this point. That is a perfectly legitimate approach if what you look at is the normal credit cycle embedded into the regular business cycle. Because by then, the fact that when you're moving financial liabilities, there may be some gap between the true price and the actual price doesn't make a big difference. But the game of macroprudential policy is the game of what drives the dynamics from these normal times, what drives the dynamics from these normal times to these crisis times. That's the game of macroprudential policy. What should I do when I'm here? Looking at what may happen when I'm over here. So that's for the regular cycle, this part. Again, local perturbation of a DSGE model with financial frictions will usually give you that and will be very good quantitatively for tracking that behavior. This is what happens in a model where, say, with 2.8% probability, you end up in a situation like this, where financial liabilities have moved sufficiently high via a credit boom, and you enter in a banking crisis episode. Then the local approximation is going to do really poorly at approximating what true asset prices will do. So how much should I worry? The values of all these things that we were looking at in this previous slide, sorry, I need to backtrack a bit. All these terms here that determine the optimal tax, all these terms that determine how big is the pecuniary externality, they all hinge critically on what's going on between these points and this point. So that's why the use of global methods, the use of nonlinear methods is very important for taking these models into the quantitative implementation for the design of these macroprudential policies in quantitative models, for the assessment, say for counterfactuals or for robustness. Even if you don't look at the optimal policy, even if what one, say, is trying to propose simple rules, like, say, a constant tax of debt, ideally what we want to know is what that simple policy rule limiting debt will do to these transitions and to the magnitude of these episodes. So what we want at the end of the day is a model where we can quantify not just these dynamics, that will be a positive theory of financial crisis, what goes from here to here, but also from these normative models of macroprudential regulation, how, if we introduce policy, we can bring the economy to situations like this. We know because the financial regulator cannot completely remove the friction. There is still some crisis events that are left. But they ought to be smaller and they ought to be less frequent. And the apparatus that we need to capture that has to be by necessity nonlinear and has to be by necessity global. Particularly if you're using your intuition, because you can already think that what's going to drive you from here to here and then back here is going to have a lot to do with mechanisms like precautionary incentives, i.e. the precautionary incentives built into the planner because the planner is looking at this are very different from the precautionary incentives that the private sector sees looking at this. That's why it's very important to have those precautionary incentives in this quantitative implementation. So that's a little bit of a detour, but the point was trying to motivate, this is something one needs to worry about in general in the game of modeling macroprudential regulations in quantitative macro models at some point. Of course, there are limitations. Global nonlinear models that we play with normally for financial crisis are smaller in scale, so they cannot accommodate as many features as we normally accommodate with, say, the typical neo-Keynesian DSGE model of monetary policy. So let me move very quickly towards thinking about showing you a little bit about what you can do in quantitatively with these kinds of models. So in our paper with Javier, you'll see all details about calibration. Some of it is somewhat orthodox about RBC style calibration. There's some aspects of it that are not. In particular, in this model, the are not which are the answer to Narayana's criticism that I mentioned earlier, is how we calibrate these financial frictions. What values, in particular, in the model that I gave you, should we give to theta and kappa? So for theta, we follow the literature. Think about the M1 that is in the possession of the firms to calibrate the working capital as a share of GDP. And in our model, conditional on the other parameters, that came to about a theta of 0.14. And kappa is really hard to calibrate at this level of aggregation, because you could think if I was exclusively thinking about mortgage borrowing for a median agent, I could say, maybe it should be 20% down payment, going down maybe to 5% down payment in the peak of the credit boom, or some dimension like that. But at this level of aggregation, kappa represents the borrowing capacity of all the agents in the economy, households and firms. So what we opted for was more of a back-of-the-envelope approach to say what we're looking for is a value kappa that pins down the frequency of crisis that we see in the data, which we round up to 3%. So that gave us about 36% for kappa. The rest is a pretty religious calibration. Here thinking about housing, so you can think and calibrate it to US data. So that is housing ratio to GDP in the US, and that's its share in the production technology. This actually makes the model hard. Financial amplification, and this was the point of Narayana's old paper, if you want, is that at higher levels of factor shares, you will have more luck with this financial amplification. So lower levels of these factor shares make it harder for these models to work. So what findings are you going to get at the end of the day? So particularly for macroprudential regulation. Macroprudential regulation is going to reduce the frequency and the magnitude of crisis. Probability of financial crisis is going to decline by a factor of 3. Asset prices are going to decline a lot less, 17 percentage points less in the typical financial crisis for the regulator versus the unregulated economy. The declines in credit and consumption will be a lot smaller, and even if you look at long-run business cycle variability, it will be a little smaller. There are also effects on asset prices. I'm not going to really talk about those, so I'm just going to put them for you to see in the slide. It's interesting also, this mechanism of endogenous financial amplification produces endogenous fat tails in the distribution of returns. I only mention it because some of the literature on financial amplification has taken advantage of thinking what would happen if we have fat tails in the distribution of returns, usually in an exogenous fashion. These are models in which the fat tails come endogenously because those are the Fisherian deflation episodes. In terms of the optimal policy, the optimal tax on debt will be about 1% on average. It's positively correlated with leverage, which has the right flavor of what we see in the narratives of discussions and policy arrangements for these macroprudential policies. On average, subsidies, dividends will be small. And I'll show you a little bit about their behavior over the time series. So just to make the point about financial amplification clear, okay, what does it mean when you look at this first batch of results? Where do they come from? They come from the fact that in this model, same-size productivity shocks can produce very large responses because of the Fisherian amplification. The states on which that Fisherian amplification can happen have an endogenous probability. Obviously, agents dislike to be in financial crisis a lot because they imply large consumption declines. So endogenously, they will try to save a lot to prevent or reduce the probability. But precautionary saving is also costly, so they will not build enough to reduce them to 0 probability. But it's important to capture just how much they're willing to do. So I'm going to illustrate that point here. So this is, think about this as the decision rule that's telling you the value of BT plus 1 along this axis, given the value of BT today, for a low realization of epsilon. The red line is the decision rule for the private agents without regulation. The blue dotted line is what the financial regulator will choose. For comparison, in a typical RBC model of the small open economy, with incomplete markets but no collateral constraints, these decision rules will normally be upward sloping, relatively linear curves that cut the 45-degree line from below. So just from looking at the U-shape of this picture, you can tell that these models are significantly nonlinear. relative to their close cousins within complete markets, but without collateral constraints. So we're breaking down this into three regions. The low externality region, the debt is relatively low. Remember, as we go in this direction, debt is lower. As we go in that direction, debt is high. So we call it the low externality region because the borrowing constraint doesn't bind today, and regardless of the realization of TFP tomorrow, it will not bind tomorrow. So that's the boring region. Not much is going to happen, and you can see the decision rule there looks pretty close to the decision rule of the typical RBC small open economy move. Then there is this high externality region. This is the core region. This is where the action is going to be. The most interesting part of the action for policy is going to be. Here is a region where the constraint doesn't bind today, but it may bind tomorrow. And here is a constraint region today for the decentralized equilibrium. Another point, pretty quickly, both the planner and the unregulated agents become constrained, and their actions are pretty similar, given again that the borrowing selections that the two agents have available, once the constraint becomes binding, are almost identical. Now, of course, you may be saying, what is the big deal? Because, this is a very small gap. So what this plot is telling you is there is only this region in which the competitive equilibrium will tolerate more debt than what the regulator will want. So this gap is the amount of overborrowing, if you want, from the perspective of this decision rule. So it doesn't look like it's a big deal, but hang on for that. So before I get there, it's how important are these three regions over the long run of this model, the stochastic steady state. So this region is about a quarter, maybe a third if you're generous, of the time where you are in the long run. Most of the time you're here, 69% for the financial regulator, 70%. So for the decentralized equilibrium. So you will spend a lot of the time not in crisis, but with a positive probability that tomorrow this could happen. And of course, crises are infrequent in the 2 months. Okay, but I want to come back to my point. How come is it that this small gap generates this so-called financial amplification? Where do I see this in these kind of pictures? So here is the point. Oh, before I get there, I raised the question before that in these models, when the constraint binds, those derivatives, the delta QT plus 1, delta VT plus 1 are very steep. That's what you see here. This is the pricing function, the value of assets as a function of B for the average, for the low realization of epsilon. Very steep when you are in the constraint region. Okay, positively slow, but very steep. That's an important ingredient of a sound model of financial crisis. So how do you get at the amplification? So for that, I'm going to zoom in. Look at this picture again. Cut off this part. So we're going to cut off this part, the low externality region. We're going to zoom in. And to zoom in, I'm going to make this axis, zoom into this axis without zooming into this axis. So my 45-degree line is still going to have the same meaning, but it's going to look flatter. Okay? So it's just zooming in this region of this picture. So this is what you get. So I want to think about the following dynamic experiment. Okay? I'm going to start the economy with the average realization of productivity. And at a point such that when I look at the decision rule for BT plus 1 of the decentralized equilibrium is the intersection with the 45-degree line. In other words, suppose I'm going to look at two contiguous periods. At the beginning of period 1, the private sector economy started with a 39% debt ratio, pretty close to 39%, and it will choose pretty much the same. So at the end of period 1, the decentralized equilibrium will be in point A. Starting from the same point, the social planner will say no, because of this overborrowing thing, and I worry about this externality, I will choose less debt. So starting from the same initial condition at the beginning of period 1, the end of period 1, the social planner will go here to point B. Just about half percentage point less debt. Okay, so between A and B, you could say the overborrowing was half a percentage point. So again, you will say, what's the big deal? Well, keep in mind, at the end of period 1, this is where the decentralized equilibrium will be with this much debt. This is where the regulator will be with this much debt. Then enter period 2, and at the beginning of period 2, you have the low realization of TFP. A typical, one standard deviation shock to TFP. Oh, sorry, some labels in there that I should have brought up. Okay, so those are all clear concepts I just talked about. Now, at the beginning of the next period, typical realization of TFP comes in. Low TFP, negative 1 standard deviation shock. This is how much the private agents are going to have to adjust. This is how much the social planner will adjust. So here is the financial amplification. This switch is where the Fisherian deflation spiral is occurring. Significant correction when you think about it. It's all one period debt. So it's a significant correction of 4.5, 5 percentage points versus a tiny correction here. So small differences in normal times cause much worse outcomes in bad times, comparing the unregulated equilibrium with the equilibrium with regulation. These models, now this is a quantitative statement, in the calibrated model that I show you, this class of models produce significant financial amplification. If you were doing typical business cycle moments and you ask, grab this model, compute the standard deviation of output over the business cycle, that's not going to look all that different, but that's because these events are low probability events. So 3.8% probability that I see, 3% probability that I see these kinds of events in this particular model. So if I look at the standard deviation of, say, consumption or output or asset prices over the long run, these events that occur with 3% probability carry small weight. Then I'm just going to play the game that suppose someone gave a simulated time series to this economy to someone doing an event analysis defining financial crisis as episodes where this constraint binds. This is what you will see. So here the red line will be typical financial crisis, 2 periods before and 2 periods after. So these are 5-year event windows. The red line is the decentralized equilibrium without regulation. The blue line is what this optimal policy of the social planner will produce. And the black line here is to characterize what an economy without regulation, but without Fisherian deflation, will look like. So for the black line, what we did is assume that the asset price of land in the collateral constraint is just constant at the long run average. So there is still a borrowing constraint, it can still bind, but there is no endogenous feedback because the price of the asset is fixed. So in this black line, we're killing the debt deflation mechanism. So that's the entire amount of Fisherian financial amplification, if you wanted to measure it. And this is the effect of the macroprudential regulation in terms of the collapsing credit at the time of a crisis. And then you can look at the other plots to see what's going to happen with consumption, much larger declines in consumption than for the regulator. There's a lot of amplification in consumption. You can look at what's happening with the asset price, what's happening with output. I'm going to go a little quicker here. But similar message. Here is the evolution of the macroprudential policy. The tax on debt is rising when the debt is rising, goes to zero when the crisis hits, very quickly becomes positive. The tax on dividends is a subsidy before the crisis, goes to a small tax at the crisis, quickly goes back into a subsidy. That's the optimal policy. This endogenous fat tail in the distribution of returns, this mass of red in this part. That's a zero probability mass on the financial regulation. Okay, so time is running out fast, so I'm not going to say, I guess I shouldn't say anything about the financial innovation connection, but I should just say, so this is work I did separate. It's a very similar model, but in this framework, what Emily Boss, who is at the IMF, and I did, was to worry about the fact that, in fact, these kappa things are part of the story. So the motivation was the U.S. crisis, to think that the financial innovation that took place in the U.S. prior to the credit boom, it meant, and also the legal changes that took place, meant that we moved from a regime where you typically had to pay 20% to a house, where you could actually pay as low as 5 or 4%. So we think about this as, say, a Hamilton-style Markov switching process, where you can go from high to low. Financial innovation meant a move to kappa low. But because it was a new event, we didn't know what the transition probabilities between these two could potentially be. So that's what the paper with Irving is about. It's about recognizing that this can potentially be a stochastic, that there could be a structural change where kappa is permanently lower. But until you have sufficient experience, you don't know if that's for sure the truth or whether the system is more unstable than you thought. So we introduced Bayesian learning about these kappas. They're fully observable, but you can learn about them. And I won't talk about the details because I'm running out of time. Here is a timeline. We use this to motivate why we think about the U.S., all the things that change in the U.S. in terms of the technology of these financial assets and in terms of the legal environment. Here is for the median down payments on housing. So you can see they went from 20% to less than 5%, and then very quickly climbed up to about 22% by 2010. So interesting kind of regime switching pattern to these CAPAs, if you want. These other measures from the U.S., the total net credit market assets of U.S. households. Think about the total debts of the U.S. households in fixed income instruments. This is the market value of residential land, so a measure of the value of land. This is a measure of the point at which financial innovation starts. Peak of the crisis, the start of the crisis will be right about here. So you can think about leverage in the context of this model in this way. So this is an interesting Fisherian dynamic, and it's exactly what Fisher says in his paper. When you look at the leverage ratio, at the ratio of debt, not relative to incomes, but relative to the value of the collateral, this is what you should expect to see. When the crisis first starts, leverage actually rises instead of falling because of the collapse in market prices. And then you can see it's very stubborn and very hard to bring down. So it was not until last year that this number began to significantly reduce. So, okay, to move faster. So we construct this model where there is learning about these regimes. The regimes are observed without noise. Binomial distributions will tell you whether you are in one regime or in the other. And your conditional expectations, one period ahead, that you must switch from the high leverage to the high leverage regime, or from the low leverage to the low leverage regime, are given by these ratios of counters of the number of times you have observed those transitions. But to be more intuitive of what this does, let me show you this picture. So let's say a candidate regime switching model. If I knew the true model, the model will be this. It's a model calibrated to saying that you have this value kappa high, this value kappa low, and the continuation probability of the high kappa regime is a lot higher. So you observe the low kappa regime a lot less. But this is a time series simulation of realizations of true kappas that will happen to this economy. The framework that I gave you, what that will mean is that the agent's beliefs about what could be the potential transition probability from high leverage to high leverage will very quickly climb, depending on the initial priors, okay, which are here. So these are very uniform priors. They cannot be zero because then the binomials are not defined, but when you bring them very close to zero, that's when you are the most uniform. So with very uniform priors, observing a short spell of high values of kappa makes people very optimistic. This is where the true probability is. This is what they think after only a few periods. So these individuals will be very optimistic about the value of housing. Therefore, they will have an incentive to buy more housing. So in this model, you have a new feature, which is that the collateral constraint can bind in the upstream. Also, your expectations about the likelihood of the low regime won't change until you observe it. So this is your initial belief. By accident, we constructed so that it is exactly the same as the true probability, but agents don't know that. So when they observe a shift from the high to the low for the first time, that changes their expectations dramatically. Again, because their priors are very uniform. So they also become very pessimistic. So here, when a crisis starts, there is an exogenous component, will be the shift on kappa. There is an endogenous component, which is the Fisherian deflation stuff. And there is another endogenous component, which is that people get very pessimistic. So now you have Fisherian deflation in steroids, if you want, because you have the amplification I just showed you from the work with Javier, where there was no informational friction, to this environment, where now on top of that, when the prices start to collapse, you get pessimistic. So you're going to demand even less of the asset. So to make the story short, Emily and I take this model to the data, calibrate it in a way that we can look at an episode that matches the US data, thinking about it as financial innovation starting in 97, the crisis starting in 2008, 2007 actually. And that will give us this dynamic for the amount of borrowing and this dynamic for the asset pricing. And we do these experiments to compare with an economy with the same dynamic of financial innovation, but with perfect information. Really like a structural change where you observe the change to kappa high. No collateral constraint. And here you have, you have the collateral constraint, but you don't have the informational friction. And in the green line, you have the collateral constraint, but again with the asset price fixed. So in this model, with the green dot, you have the informational friction, but you don't have the collateral constraint. So you can see the idea of this plot was to illustrate the different dynamics to characterize that the combination of the two adds and compounds to what you already have with just the Fisherian deflation. It makes it a lot stronger. Then also here is the projected path of the return on assets. This is what the data show for the Fannie Mae asset-backed securities, mortgage-backed securities, different models into the actual data, and then a forecast of excess returns for one period ahead. This is what our model predicts, the blue line. So for being such a Mickey Mouse model, it tracks pretty well the evolution in the data of the spec returns on housing as an asset. This is a measure of how much it can give you at the peak of optimism in terms of the change of credit. This is what the data showed. This is what the model shows in terms of the increase in asset prices and the reversal at the time of the crisis. And here the comparison across the other columns is again to contrast with the models where we take out either the informational friction or where we take out the Fisherian deflation. So the interaction is important. This also has implications for the macroprudential policy, but I will leave those for the questions. And I was going to raise some conclusions as well, but maybe I'll just let you ask the questions, and if you want to look at the conclusion slide, I think you can do that for yourself.
Thank you very much, Enrique. So just as a reminder, you can always use the set status icon that is on the middle, on the center top part of the screen, and there you can raise your hand. If you raise your hand, we can open your microphone.
Okay, very good. So there was this question from Alberto about with Marco Terrones looking at the mice where we think about those as credit crunch. Yes, indeed, but not the way we look at the data. The data, while we're looking at this 3 periods later, what's going on with the serial component of credit. You can see that it's already moving below trend in some of the episodes quite significantly. That's why the mean and the median are significantly below trend. But from the context of the definition in the model that I just gave you, we're not sure those are actual credit crunches. So indeed, from the context of the model or some empirical work, it would be nice to see how many of the credit booms ending in actual credit crunches. And you can say we know that 1/3 of them ending in banking crisis. So to the extent that you can equalize banking crisis with credit crunch, we could say that as a proxy, that is 1 out of every 3. So we don't have a question. I can tell you a little more about this interaction with the financial innovation. Okay, someone's typing. So that has to do with who will have more information, the private agents or the regulator. That turns out to be an important issue, and it's difficult to sort out. And in our paper, we did a paper together, Emily Voss, and Javier Bianchi and I, which is in the IMF Economic Review, looking at the interaction. If we allow for the fact that financial innovation happens, how do you redesign the macroprudential policy? And then, of course, key question is whether the financial regulator is more or less informed about what's going on with the financial environment. Yes, so the question about the underlying micro story. I think those are very important questions. My colleague Guillermo Ordóñez, for example, here in his work with Gary Gorton, think about their paper on collateral crisis in the AER fairly recently. I can give you a theory of where these collateral constraints come from, and it can give you incentive or a hint about where regulation could go into different areas. So in their stories, the story has to do with whether what kind of information is required for what kinds of borrowing. There can be information-insensitive debt and information-sensitive debt. Those kinds of constraints can produce the necessity to use collateral and can endogenize the values of these kappas. But beyond that, to generalize more, I think for the point that I was making earlier, there are questions about which this class of models, where one takes as given a collateral constraint with some kappa, are going to be limiting questions. So here I'm taking as a given the reason why creditors may want to restrict credit to the value kappa. Could be a limited enforcement problem, could be these informational frictions that Gorton and Ordonez have, could be a variety of things. And it may be that those things are related to the design of the policy. In fact, most likely, they are related to the design of the policy. So I think this is very important, also for the reason that I mentioned earlier. If you just take these models where the collateral constraints are taken as a given, you may end up pushing these arguments of macroprudential policy as taxes or this Pigouvian approach so far as to render the entire credit constraint mute. And I think that is a nice intellectual exercise, but it's not very relevant, because when you think about how to decentralize it, you will have to come back and ask, well, wait a minute, what was the contractual friction that led to the constraint in the first place? And can these other, say, taxes that I could design to recover the optimum without credit frictions actually lead creditors and borrowers to want to engage in transactions that match those amounts of credit? So I think it is a very important issue. Sure, no problem.
We can take advantage of the webinar, Enrique, to let SEMLA's members that there will be a course that will teach many of the methods that you mentioned, the nonlinear global methods, in 2015. We're still working on the dates, but most likely that will be during the summer of next year. Would you like to tell people a little bit about what would you teach in that course?
Sure. So as I was suggesting, you could see the characterization that I made was a broad one about why in these models of macroprudential regulation you need to focus on these transitions between periods of financial normalcy and periods of financial distress. So the idea of the course is to start from the beginning, from the framework of incomplete markets models, characterize them in a global framework, those simpler models, understand the mechanism through which precautionary saving works, redefine concepts that we normally use to think about a stochastic stationary equilibria, the determination of those equilibria, the existence of those equilibria. First, in these environments where the collateral constraints are simply the fact that credit markets are incomplete, that you don't have Arrow-Debreu markets or Arrow securities. And then the next layer is to bring in this type of occasionally binding collateral constraints, and again in the context of the global methods, and to discuss them in the context of specific examples where we'll be providing output files and the algorithms under which these models can be solved, and showing you the specific exercises like the one I showed you here. In the context of a model, actually we're planning to use the one that uses tradable and non-tradable goods. There's another class of models in which a very similar presentation to the one I just made at a very intuitive level. The same arguments I just applied for the asset price of land and financial amplification can apply to an economy that has a large non-tradable sector that borrows in units of tradables. In that case, the amplification will occur via the price of non-tradables, and the macroprudential policy will come through similar vehicles of taxation or alternative decentralization. So we're going to do this in the course using specific examples that are solved, and that you can see the actual algorithms for how they work. You can also, and we will also use them to look at different policies. Optimal policy is nice. It's nice in academia, but it's also in policy circles something that seems always more theoretical than practical. So we're very interested, and that's also part of the work we're doing and have done, to show how this can be done, to evaluate counterfactuals where you can discuss simple policies, and you can actually look at payoff functions and look at loss functions to characterize what an quote-unquote optimal policy may be from the perspective of reducing the welfare loss, even if you cannot actually go to the optimal policy that the theory predicts. So there's going to be a variety of things. Some of them are the level of the macro theory of these models of financial frictions, but most of them we have and are geared toward the quantitative implementation of these models for the use of the design of macroprudential tools and for the solution of models with occasionally binding credit frictions.
Thank you very much, Enrique. If anyone else has a question, again, please feel free to use the chat window or raise your hand. And in case there are not further questions, we'll thank Enrique Mendoza for today's presentation. Please remember that we have our schedule in the research seminars webpage. We'll have some other seminars that due to with modeling topics. Next month we'll have Nobu Kiyotaki talking about a paper he has with Mark Gettler on banking, liquidity, and bank runs in an infinite horizon economy. We'll also have Douglas Laxton talking about MapMod, a new model that they have developed at the IMF to talk about financial crisis in DSG models. And we'll have Anina Kashyap, who will talk about how does macroprudential regulation change bank credit supply. So I think all these 4 papers together with today's presentation complement each other very nicely on how to think about financial factors into general equilibrium models. So again, thank you very much, Enrique, and thank you very much to everyone who joined us today.
Thank you very much. It's a pleasure.